The average person views a bank as a place where money is kept. This is the first and perhaps most fundamental misunderstanding of the modern financial system. In reality, a bank is a risk management machine that operates on a spectrum of institutional indifference. On one end of that spectrum, the institution views the depositor as a source of fee income and a minor liability. On the other end of that spectrum, the institution views the individual as a partner in the movement of global capital. There is an invisible line where the rules of the game change entirely. This shift does not happen gradually. It happens at specific calculated thresholds, where the bank's internal risk modeling shifts from protectionism to facilitation. Before exploring the specific mechanics of these thresholds and how the banking system alters its behavior based on the weight of a ledger, it is worth noting the importance of understanding these hidden structures. Subscribing to this channel provides a consistent window into the analytical frameworks used by the world's most powerful financial institutions, allowing for a clearer view of how wealth and risk actually interact behind the scenes. To understand the change in treatment, one must first understand what a deposit actually is. To a retail customer, a deposit is an asset. To a bank, a deposit is a liability. It is money the bank owes to the customer. When an account holds $5,000, the bank spends more on the electricity to run the ATM and the salary of the teller than it earns from that deposit. Consequently, the retail banking experience is designed to be automated, cold, and extractive. Fees are not accidental. They are a mechanism used to offset the cost of maintaining small-scale liabilities. In this tier, the system is designed to discourage human interaction. The goal of the institution is to move the customer toward an app or a website, reducing the cost to serve to as close to zero as possible. However, as the numbers on the balance sheet grow, the bank's perspective begins to shift. At the first major threshold, often recognized around the $250,000 mark, the retail label begins to peel away. This is where premier or preferred banking emerges. It is the first sign that the institution has flagged the account as something other than a pure liability. At this stage, the bank begins to waive the petty fees that define the retail experience. The reason is not out of a sense of fairness, but rather a calculation of customer lifetime value. The data suggests that individuals at this level are likely to require larger financial products in the future, mortgages, insurance, or investment accounts, and the bank's priority shifts from extraction to retention. The real transformation, however, occurs at the $1 million mark in liquid assets. This is the entry point into private banking. In the halls of firms like JP Morgan, Goldman Sachs, or Morgan Stanley, this is where the high net worth or HNW designation is applied. At this level, the institution stops treating the individual as a customer and begins treating them as a client. The difference is profound. A customer is someone who buys what is on the shelf. A client is someone for whom the institution builds a bespoke solution. What tends to happen at the $1 million threshold is the introduction of the dedicated relationship manager. This is the point where the bank's internal KYC, or Know Your Customer protocols, move from a digital checklist to a human relationship. The bank now has a vested interest in the client's entire balance sheet, not just the cash in the account. This is where the concept of Lombard lending or securities-backed lines of credit begins to surface. For the retail depositor, a loan is something that requires an application, a credit check, and a long wait. For the private banking client, credit is often presented as a utility.
The pattern that emerges in private banking is the decoupling of wealth from spending. At this level, individuals rarely spend their own cash. Instead, they borrow against their assets. If an individual has $5 million in a diversified stock portfolio, the bank will often provide a line of credit at a very low interest rate, frequently just a small margin above the benchmark rate, using the portfolio as collateral. This allows the individual to access liquidity without selling their assets, thereby avoiding capital gains taxes and keeping their capital invested. The bank facilitates this because the risk is incredibly low. If the market drops, the bank can simply liquidate the portfolio to cover the loan. The institution is no longer just a vault. It has become a tool for the velocity of capital. As the numbers climb toward the $10 million and $25 million thresholds, the categorization moves into ultra-high net worth, or UHNW. At this level, the retail bank branch essentially ceases to exist. These individuals deal with private offices or family offices. The institutional behavior here is characterized by extreme flexibility. The rules that govern standard banking, withdrawal limits, standard interest rates, and rigid loan terms simply evaporate. In the UHNW tier, the data suggests that the bank's primary goal is wallet share. They want to be the sole provider for every financial need of that family or individual. To achieve this, they offer access to alternative investments, private equity, hedge funds, and venture capital deals that are legally off limits to the general public under SEC regulations. The logic used by the system is that these individuals have the sophistication and the risk appetite to handle complex products. In reality, it creates a circular system where the wealthiest participants have access to the highest yielding opportunities, which are protected by a wall of regulation designed to protect smaller investors from the very same returns. One of the most significant shifts at the $10 million plus level is the institutional response to risk. For a retail borrower, risk is a personal burden. If a mortgage isn't paid, the house is taken. For an institutional level client, risk is a shared commodity. When a client of this magnitude seeks a $50 million loan for a real estate development, the bank does not just look at a credit score. They look at the syndication potential. They look at how they can slice that risk and sell it to other institutions. The individual's wealth acts as a catalyst for the bank to generate fees by moving money around the global system. At this level, the client is essentially a small corporation, and the bank treats them with the same level of analytical rigor and white glove service they would afford a mid-sized tech company. The invisible thresholds also dictate how an individual interacts with the law and the state. In the lower tiers of banking, the institution acts as an informal arm of the government. Suspicious activity reports, SARs, are filed automatically by algorithms for transactions as small as $10,000. The retail customer is often forced to prove their innocence to their own bank if a transaction looks unusual. However, as the wealth threshold crosses the $50 million or $100 million mark, the compliance experience changes. While the legal requirements remain, the way they are handled is entirely different. Instead of an automated freeze on an account, a private banker will typically call the client's chief financial officer or their legal team to clarify the nature of a transaction before any flags are raised. The institution provides a layer of insulation between the individual and the regulatory apparatus. This is not necessarily illegal, but it is a functional reality of how wealth changes the physics of institutional oversight.
The concept of counterparty risk also evolves as one moves up the ladder. For the average person, the bank is a monolith. They assume the bank will always be there. For the ultra-wealthy, the bank is a counterparty that must be managed. They do not keep $20 million in a single checking account. They use sweep accounts that automatically distribute cash across dozens of different institutions to ensure every dollar is covered by FDIC insurance. Or they keep their cash in short-term treasury bills held in custody rather than as a deposit on the bank's balance sheet. At this level, the individual understands that they are lending money to the bank, and they demand security for that loan. The most rarefied tier is the institutional or sovereign level, typically involving assets north of $500 million or $1 billion. At this stage, the individual or the family office is treated like a small country. They have direct access to the bank's trading desks. They can execute currency trades or buy gold at the same prices the bank itself pays. They are no longer paying a retail spread on anything. The institution's behavior at this level is purely focused on the macro relationship. They will often provide loss-leading services, such as expensive tax structuring or estate planning, for free, simply to ensure the multi-generational capital remains within their ecosystem. It is also important to observe the social architecture of these thresholds. Banks often host thought leadership summits or exclusive retreats for their top-tier clients. These are not merely vacations. They are curated networking environments where the bank acts as a matchmaker. They introduce the owner of a manufacturing conglomerate to the head of a private equity firm. They facilitate the flow of information and deals. By doing this, the bank makes itself indispensable. They are no longer just a utility. They are the central hub of a private economy. The retail customer is never invited to these rooms because, in the eyes of the institution, the retail customer has no deal flow to offer. The data regarding wealth concentration suggests that the role of debt at the upper thresholds cannot be overstated. In the retail world, debt is often viewed as a burden or a sign of financial struggle. In the world of high finance, debt is a strategic tool. The pattern that emerges among the wealthy is the use of asset-based lending to maintain a lifestyle without ever showing a taxable income. An individual might take a $10 million loan against their stock portfolio to buy a yacht or a primary residence.
The interest on that loan is often lower than the dividend yield or the growth rate of the portfolio itself. By using debt, they are effectively spending their wealth without realizing it in the eyes of the tax authorities. The bank is the enabler of this strategy. They provide the liquidity, take the interest, and hold the collateral. Everyone in the transaction wins, except for the public treasury. Furthermore, the threshold of visibility affects how institutions handle failure. If a retail customer loses their job and defaults on a $50,000 personal loan, the bank's collection department is relentless. The credit score is destroyed, and the debt is often sold to a third-party collector. However, if a client with a $100 million relationship faces a liquidity crisis, the bank's workout group steps in. They don't want to liquidate the client, they want to restructure the debt. They will often extend the terms, lower the interest rate, or take a temporary equity stake in an asset. This is the origin of the phrase, if you owe the bank $100, that's your problem. If you owe the bank $100 million, that's the bank's problem. At the higher thresholds, the bank is so deeply entwined with the client's success that they cannot afford to let them fail. The behavior of these institutions is also influenced by capital adequacy regulations like Basel III. These rules dictate how much capital a bank must hold against its loans. Interestingly, loans to high net worth individuals, especially those backed by liquid securities, are often treated as low risk by regulators. This means the bank has to set aside very little capital to make these loans. This creates a massive incentive for banks to lend to the wealthy. It is more capital efficient for a bank to lend $50 million to one billionaire than it is to lend $50,000 to 1,000 different small businesses. The regulatory framework itself pushes the banking system towards the top of the pyramid. This structural bias is rarely discussed in mainstream economic circles because it complicates the narrative of a free market, where everyone competes on a level playing field. The reality is that there are multiple fields, and the one you play on is determined by the number of zeros in your account. The rules of money that are taught in schools, save your money, pay off your debt, live within your means, are the rules for the retail tier. They are designed to create stable, predictable depositors who provide the base layer of liquidity for the system. For those who operate above the thresholds, the rules are different. The goal is not to save, but to deploy. The goal is not to pay off debt, but to manage the spread between the cost of borrowing and the return on capital. The goal is not to live within one's means, but to expand one's means through leverage and institutional partnerships. Understanding these invisible thresholds is essential for anyone seeking to analyze how power and capital truly move. The banking system is a mirror of the social hierarchy, reflecting the hard reality that institutions do not value all individuals equally. They value them based on the risk they represent and the profit they facilitate.
As the world moves toward more digitized and transparent financial systems, some might expect these thresholds to disappear. However, the data suggests the opposite is happening. The use of big data and AI is allowing banks to segment their clients with even greater precision. They can now identify emerging high net worth individuals before they even reach the $1 million mark, pulling them into the private banking ecosystem earlier. At the same time, the automation of retail banking is becoming more absolute, further distancing the average person from the levers of financial power. The invisible thresholds are not just about money, they are about agency. Below the line, you are a subject of the system. You follow the forms, you wait in the lines, and you accept the terms offered. Above the line, you are a participant. You negotiate the terms, you design the products, and you use the institution as an extension of your own will. This brings us to the most guarded secret of the financial world. The system is designed to keep people below the thresholds. The fees, the high interest rates on consumer debt, and the lack of access to sophisticated investment vehicles all act as gravity. They make it difficult for capital to accumulate. For the system to function, it needs a large base of retail depositors to provide the cheap capital that the bank then lends out to the institutional tier. If everyone understood how to use the bank as a tool rather than a vault, the bank's profit margins would collapse. The pattern of institutional behavior is consistent across borders and cultures. Whether in New York, London, Zurich, or Singapore, the thresholds may vary slightly in currency, but the psychological and structural shifts are identical. The institution seeks to de-risk its relationship with the small and maximize its leverage with the large. It is also worth observing how these institutions behave during times of crisis. In a recession, retail credit dries up almost instantly. Credit card limits are slashed, and mortgage applications are rejected. But for the Tier 1 clients, the bank often remains open for business. In fact, crises often present the best opportunities for those with access to institutional liquidity. When asset prices drop, the private banking client uses their line of credit to buy the dip, while the retail customer is focused on simply maintaining their balance. This is how wealth concentration accelerates during periods of volatility. The invisible thresholds are the true borders of the modern world.
They are more significant than national boundaries because they determine what a person is allowed to do with their time and their capital. They determine who gets a phone call back and who gets an automated recording. They determine who is protected by the system and who is consumed by it. The reason this information is rarely discussed in the public sphere is simple. The institutions have no incentive to broadcast it, and those who have crossed the thresholds have no desire to share the cheat code. The banking system relies on a certain level of financial illiteracy to maintain its margins. By keeping the mechanics of private banking and institutional leverage shrouded in mystery and exclusivity, the system ensures that the majority of participants remain as depositors rather than players. This channel focuses on these mechanics because the story of money is usually told through the lens of politics or consumerism, but the real story is written in the ledgers of the world's major banks. By observing the patterns, the data, and the institutional responses, we can begin to see the skeleton of the global financial system.
The thresholds are not permanent, but they are incredibly resilient. They are guarded by regulation, by technology, and by the sheer weight of existing capital. To understand why the world works the way it does, one must look at where the banks stop saying no and start saying, how can we help? The transition from a retail liability to an institutional partner is the most significant event in a person's financial life. Yet it is an event that happens in silence, behind closed doors, marked only by a change in the color of a credit card or the title of the person answering the phone. It is a shift in the very nature of one's relationship with the world of value. As we continue to break down the invisible thresholds of wealth and the hidden behavior of financial institutions, it becomes clear that the rules of the game are not written in a single book. There are different books for different players, and the bank is the one who decides which book you get to read. This analysis is not meant to be prescriptive, but rather a cold look at the reality of the landscape. The pattern is clear. The more capital one has, the less it costs to use it. The more risk one can collateralize, the more the system will bend to accommodate it. This is the fundamental asymmetry of modern banking, and it is the mechanism that drives the world we live in today. The reason these dynamics remain in the shadows is that they challenge the fundamental assumption of economic equality. They reveal a system that is meticulously tiered and intentionally opaque. But by observing these thresholds, we gain a clearer understanding of the invisible architecture that governs everything from the price of a home to the stability of a nation's currency. The bank is not just a place for money, it is the gatekeeper of the thresholds. And knowing where those gates are and how they open is the first step in understanding how the world really works. This information is rarely discussed because it reveals that the financial system is not a public utility, but a private club where the membership fee is the very wealth the system is designed to manage. By documenting these patterns, we provide a map of a territory that is usually kept off the charts. The more one understands the behavior of the institution, the less one is surprised by the outcomes of the economy. Wealth, cash flow, and risk are the variables, but the thresholds are the constants. Understanding them is the key to seeing the world as it actually